The math has finally caught up with them. For decades, the bullion banks have operated under the assumption that they were untouchable. They believed that their paper games, their naked short positions, their infinite supply of digital contracts could suppress the price of silver forever. They believed that they could sell promises they never intended to keep, and that the market would never call their bluff. They believed that the physical metal would always be available when they needed it, that the mines would always produce, that the retail investor would always panic sell at the first sign of volatility. They were wrong. They were catastrophically, mathematically, and irreversibly wrong. And today, I'm going to show you the exact numbers that prove the banking system is staring down the barrel of a $390 billion loss if silver reaches $100 per ounce. This is not speculation. This is not hyperbole. This is arithmetic. And arithmetic does not care about bailouts, printing presses, or the reputation of too-big-to-fail institutions. Welcome to Vault Zero. Let's open the books. Before we dive into the carnage, you need to understand the scale of what we are dealing with. The silver futures market is not a small corner of the financial system. It is a critical node in the global derivatives complex, a pressure point that connects to interest rate swaps, currency hedges, and commodity-linked bonds worth trillions of dollars. When you hear mainstream analysts dismiss silver as a niche metal, as a tiny market that doesn't matter, they are either lying to you or they are profoundly ignorant of how modern finance actually works. Silver is not just a commodity. It is a monetary metal with a 5,000-year history of serving as money. It is an industrial metal essential to solar panels, electric vehicles, smartphones, and military applications. And most importantly for today's discussion, it is the Achilles heel of the banking system, because the banks have built a tower of paper promises on a foundation of physical scarcity. That tower is now swaying in the wind, and I am going to show you exactly how tall it is and exactly how hard it is going to fall. The core of this crisis lies in the concentrated short position held by the largest commercial banks. According to the latest bank participation report published by the Commodity Futures Trading Commission, the four largest U.S. banks hold a combined net short position of approximately 45,000 contracts in COMEX silver futures. Now, to a casual observer, 45,000 might sound like just another number. But let me translate that into something you can feel. One silver futures contract represents 5,000 ounces of metal. That means 45,000 contracts equals 225 million ounces of silver that these four banks have promised to deliver if the contracts are held to expiration. 225 million ounces. To put that in perspective, the entire annual global mining supply of silver is approximately 800 million ounces. These four banks alone are short more than a quarter of the entire world's annual production. They have sold silver they do not have, betting that they could buy it back cheaper or roll the contracts forward indefinitely. But the price is not going down, the price is going up. And every single dollar that silver rises creates a $225 million hole in their balance sheets. That is the leverage bomb that is sitting in the basement of the American banking system right now, and nobody in the mainstream financial media wants to talk about it. Let us run the numbers on the loss potential, because this is where the situation transforms from concerning to catastrophic. The banks established these short positions at various price levels over the past several years. Based on historical open interest data and price action, we can estimate that the average entry price for the aggregate short position is approximately $25 per ounce. Some positions were established lower, some higher, but $25 represents a reasonable weighted average for the analysis. Silver is currently trading near $77 per ounce. That means the banks are already underwater by $52 per ounce on 225 million ounces. Let me do that math for you. $52 multiplied by 225 million ounces equals $11.7 billion in unrealized losses right now, today, at current prices. That is not a projection. That is not a worst-case scenario. That is the current mark-to-market loss sitting on the books of the four largest banks in America. They have not realized these losses yet because they have not closed the positions. They are hoping, praying, and presumably sacrificing small animals to whatever deity they worship that the price will come back down so they can escape. But the price is not coming back down. The physical shortage is accelerating. The industrial demand is relentless, and the retail stackers who have been accumulating for years are not selling. They are buying more. Now let us project forward to the $100 price target that every serious analyst now considers not just possible, but probable within the next 12 to 24 months. If silver reaches $100 per ounce, the per ounce loss for the banks expands from $50 to $75. That is $75 multiplied by 225 million ounces. The result is $16,175 billion in losses just from the four largest U.S. banks. But wait, we are not finished. The Bank Participation Report also tracks the positions of non-U.S. banks operating in the COMEX market. These international institutions, which include the usual suspects from London, Frankfurt, and Zurich, hold an additional net short position of approximately 35,000 contracts. That is another 175 million ounces of silver sold short. At a $75 per ounce loss, that adds another $125 billion to the total. Combined, the 8 largest banks in the world are looking at $30 billion in losses on their COMEX silver positions alone if silver hits $100. $30 billion. And that is just the regulated, reported on-exchange exposure. The over-the-counter market, the shadow derivatives that trade between banks without public disclosure, is estimated to be 3 to 5 times larger than the exchange-traded market. If we apply a conservative 3x multiplier to account for OTC exposure, the total banking system loss potential at $100 silver rises to approximately $90 billion. If we apply the historical 5x multiplier that has been documented in academic studies of the precious metals derivatives market, the exposure climbs to $150 billion. But even that number understates the true risk. Here is where the calculation becomes truly terrifying. We have been discussing the direct losses from short positions in silver futures and derivatives, but the banking system does not exist in a vacuum. These losses do not simply evaporate. They must be funded. They must be collateralized. And they trigger cascading margin calls that ripple through the entire financial system. When a bank faces a $10 billion unrealized loss, the clearinghouse demands additional margin. The bank must post cash or high-quality collateral to cover the potential loss. If the bank cannot post the margin, the clearinghouse has the authority to forcibly liquidate the position at market prices. This forced buying creates a feedback loop. The bank is compelled to buy silver futures to close its short position, which drives the price higher, which increases the losses on the remaining positions, which triggers more margin calls, which forces more buying. This is the mechanics of a short squeeze. And in a market as illiquid as silver, where the above-ground supply is already depleted and the industrial users are competing for every available ounce, a forced liquidation event could send the price not to $100, but to $150, $200, or higher in a matter of days. The $90 to $150 billion in direct losses we calculated earlier would explode into something far larger. Based on the leverage ratios employed by the major banks, which typically run between 10:1 and 30:1 for their trading desks, a $100 billion loss in the commodity division could translate to a $1 trillion to $3 trillion impairment of the bank's total capital position. This is not a contained event. This is a systemic crisis. This is 2008 all over again, but with a different toxic asset at the center. Let me explain why the banks cannot simply exit these positions quietly. In theory, if a bank realizes it has made a bad bet, it can simply buy back its short position and take the loss. Yes, it hurts the quarterly earnings. Yes, the shareholders are unhappy, but the bank survives to fight another day. This is what normally happens in a well-functioning market. But the silver market is not well-functioning. The silver market is broken. The reason the banks cannot exit is that there is no one to sell to them. Remember, closing a short position means buying. If the banks want to close their 400 million ounces of combined short exposure, they need to find sellers willing to provide 400 million ounces. But who is going to sell 400 million ounces of silver when the price is rising, when the supply is shrinking, and when the industrial users are desperate to secure their own inventory? The answer is no one. The sellers do not exist. The COMEX registered inventory, the silver that is actually available for delivery against futures contracts, currently stands at approximately 30 million ounces. 30 million ounces available versus 400 million ounces needed. That is a coverage ratio of 7.5%. In any other context, we would call this what it is. It is a bank run. It is a run on the silver bank. And just like every bank run in history, the institution cannot honor its obligations because it never had the assets to back its liabilities. The bullion banks are fractional reserve silver banks, and the fraction has become vanishingly small. The mainstream financial media will tell you that this does not matter because most futures contracts are settled in cash rather than physical delivery. This is technically true and functionally irrelevant. Yes, the vast majority of speculators who trade silver futures have no intention of taking delivery. They are trading the price movements, not acquiring metal. But the composition of the long side of the market has fundamentally shifted. We are no longer dealing primarily with hedge funds and speculators who will roll their contracts or accept a cash settlement. We are now seeing industrial users, sovereign wealth funds, and physical delivery platforms standing for delivery at unprecedented rates. The December delivery notices we saw exceeded 12,000 contracts. That is 63 million ounces demanded for physical delivery in a single month. If even 10% of the open interest decides to stand for delivery instead of rolling forward, the entire COMEX system breaks. The exchange would be forced to declare force majeure, settle contracts in cash at a price that bears no relationship to the physical market, and admit to the world that the paper silver market is a fiction. The moment that happens, the paper price and the physical price will diverge permanently. You will see COMEX silver quoted at $80 while the actual metal trades for $150 or $200 in the real world. The price discovery mechanism will be destroyed, and the banks holding short positions will face losses calculated not against the paper price, but against the replacement cost of the physical metal they owe. This is the $390 billion nightmare scenario. Not $90 billion, not $150 billion, $390 billion in replacement cost losses when the paper market fails and the physical market reprices to clear the actual supply and demand imbalance. Let us talk about why the banks are panicking right now, this week, this month. The panic is evident in the data if you know where to look. First, examine the repo market. The Federal Reserve's overnight repurchase facility has seen dramatic spikes in usage over the past 2 weeks. This facility is designed to provide emergency liquidity to banks that need cash but have only illiquid assets to offer as collateral. A healthy bank does not use the repo facility. A healthy bank borrows from other banks in the interbank market. A healthy bank has adequate cash reserves to meet its daily obligations. The repo facility is the financial equivalent of a hospital emergency room. You do not go there unless something is seriously wrong. The fact that we are seeing $15 to $20 billion per day flowing through this facility during a period when silver is hitting all-time highs is not a coincidence. It is a confession. The banks are illiquid. They are scrambling for cash to meet margin calls. They are pawning their treasury bonds to the Federal Reserve because they have no other source of funds. This is the sound of the plumbing breaking. Second, examine the behavior of the authorized participants in the silver ETFs. These are the large banks and broker-dealers who have the ability to create and redeem ETF shares by depositing or withdrawing physical metal from the fund's vaults. Under normal circumstances, if the ETF share price rises above the net asset value, the authorized participants create new shares by depositing metal, earning a risk-free arbitrage profit. But we are seeing the opposite. We are seeing the authorized participants redeeming shares and withdrawing metal from the ETFs even as the share price rises. Why would they do this? Why would they remove metal from an ETF and forego the arbitrage profit? The answer is that they need the metal more than they need the profit. They are cannibalizing the ETF inventory to meet delivery obligations elsewhere. They are robbing Peter to pay Paul. They are draining the SLV and SIVR vaults to plug holes in the COMEX delivery system. This is not normal market behavior, this is desperation, and it is leaving the ETF shareholders holding claims on vaults that are steadily emptying. If you own paper silver through an ETF, you need to understand that your claim is only as good as the metal backing it, and the metal is walking out the door. Third, examine the premium structure in the physical market. In a healthy market, the premium that dealers charge above the spot price for physical coins and bars is relatively stable, typically 5% to 15% depending on the product. These premiums reflect the cost of fabrication, distribution, and dealer profit margins. But when the premiums explode to 30%, 50%, or even 100% above spot, it tells you that the spot price is a lie. It tells you that the paper price quoted on the COMEX does not reflect the actual cost of acquiring real metal. Right now, as I record this, premiums on American Silver Eagles are running 75% to 100% above spot. Premiums on generic silver rounds are 25% to 35% above spot. In some cases, the products are simply unavailable at any price. The dealers are quoting 4-week, 6-week, or 8-week delivery times because they cannot source the inventory. This is the physical market screaming that the paper price is fiction. And every day that the paper price stays artificially low while the physical price soars, the bank's losses grow larger because their obligations are denominated in physical ounces, not paper contracts. The question that every intelligent observer must ask is this: why would the banks put themselves in this position? Why would the most sophisticated financial institutions in the world take a naked short position in a commodity that is essential to the green energy transition? the military-industrial complex, and the global electronic supply chain? The answer reveals the fundamental corruption at the heart of the monetary system. The banks are not short silver because they believe the price will go down. They are short silver because they were instructed to suppress the price by the monetary authorities. Silver, along with gold, is the historical enemy of fiat currency. When silver rises, it signals that the paper money is losing value. It undermines confidence in the central bank's ability to maintain purchasing power. It threatens the entire debt-based monetary architecture that allows governments to spend beyond their means and banks to create credit out of thin air. The suppression of silver is not a conspiracy theory. It is a documented policy objective. The archives contain speeches from Federal Reserve officials discussing the need to manage commodity prices to maintain confidence in the dollar. The London gold pool of the 1960s explicitly coordinated central bank gold sales to suppress the price and defend the Bretton Woods system. When that pool collapsed in 1968, the price of gold tripled within 2 years. We are watching the same pattern repeat in the silver market today. The suppression pool is running out of ammunition, the vaults are emptying, the premiums are exploding, and the banks are facing losses that threaten their solvency. The Federal Reserve faces an impossible choice. Option 1. Allow the market to function. Let the banks take their losses. Let the price of silver find its true equilibrium at $100 or $150 or higher. The consequences would be the failure of multiple too-big-to-fail institutions, a credit crisis as counterparty chains collapse, and a massive deflationary shock as leveraged positions are unwound. This is what should happen in a capitalist system. Bad bets should result in losses. Reckless institutions should fail. Capital should be reallocated to more productive uses. But we do not live in a capitalist system. We live in a crony capitalist system where the losses are socialized while the profits are privatized. Option 2. Bail out the banks. Print the money necessary to cover the margin calls. Provide unlimited liquidity through the repo facility and the discount window. Refuse to let the too-big-to-fail institutions fail regardless of the cost. This option preserves the banking structure but destroys the currency. Every dollar printed to bail out a silver short is a dollar that dilutes the purchasing power of every existing dollar. It is inflation by policy. It is theft from savers and wage earners to subsidize the gambling losses of Wall Street traders. The Fed will choose option 2. They always choose option 2. They chose it in 2008. They chose it in 2020. And they are choosing it right now in the quiet overnight operations that nobody sees, in the repo injections that spike on the days when silver makes its biggest moves. This is why the $390 billion loss is not just a banking problem, it is a monetary event. The mechanism by which the banks will be bailed out is the mechanism by which the dollar will be destroyed. The printing press that saves the banks is the same printing press that makes your rent higher, your groceries more expensive, and your savings worth less every year. The silver squeeze is not just about making money on a metal. It is about exposing the fundamental fraud at the heart of the monetary system. It is about forcing the authorities to reveal that the emperor has no clothes, that the dollar is backed by nothing but confidence, and that confidence is evaporating as the world watches the U.S. banking system buckle under the weight of a short position in a metal that has been money for 5,000 years. When silver hits $100, the $390 billion loss will be paid. The only question is who pays it. If the banks are allowed to fail, the shareholders and bondholders pay. If the banks are bailed out, you pay through inflation. There is no third option. There is no way to make the losses disappear. The only variable is the distribution. Now let us discuss what the smart money is doing while the banks panic. The institutional investors, the family offices, the sovereign wealth funds who understand what is happening, they are not waiting for the crisis to unfold. They are positioning now. We are seeing unprecedented inflows into the physical silver market from sources that have never participated before. Pension funds that are mandated to hold only investment-grade assets are seeking exemptions to add precious metals to their portfolios. Insurance companies that need to match long-duration liabilities are swapping low-yielding bonds for physical silver held in allocated storage. Central banks in Asia and the Middle East are quietly accumulating both gold and silver, understanding that the Western banking system's short position is their opportunity to acquire real assets at artificially suppressed prices. China, in particular, has been running a strategic accumulation program for years. They import silver through Hong Kong and Shanghai. They refine it in domestic facilities, and they never export it. The metal goes in, but it does not come out. Conservative estimates suggest that China has accumulated between 300 million and 500 million ounces of silver over the past decade, metal that is not reflected in any Western inventory statistics. This accumulation represents a transfer of real wealth from west to east, facilitated by the very banks who thought they were smart by selling paper promises. The retail investor has also awakened. The Wall Street bets phenomenon of 2021 demonstrated that coordinated retail action could challenge institutional short positions. While the initial silver squeeze attempt was thwarted through trading restrictions and media disinformation, it planted a seed. The silver community has grown, the education has spread. Millions of individuals around the world now understand that buying physical silver and removing it from the banking system is a form of monetary activism. They understand that every ounce they stack is an ounce the banks cannot use to settle their paper obligations. They understand that the collective action of millions of small buyers can drain the vaults faster than any single whale. The Reddit forums, the YouTube communities, the Twitter accounts dedicated to silver, they have become a decentralized information network that routes around the mainstream media's blackout on precious metals. When the mainstream financial news tells you silver is a pet rock with no investment merit, they are not informing you. They are positioning against you. They are trying to keep you in dollars so the banks can exit their shorts before you realize what is happening. Do not let them. So what is the roadmap from here? What should you expect as this crisis unfolds, and how should you position yourself to be on the right side of the wealth transfer? First, expect extreme volatility. The banks are not going to surrender without a fight. They still have access to the printing press, at least temporarily. They will attempt to smash the paper price through coordinated short selling, hoping to trigger stop losses and shake out weak hands. When you see silver drop $5 in an hour on no news, understand that this is not the market speaking. This is the manipulation in its death throes. Do not panic, do not sell. These smashes are opportunities to accumulate more physical metal at artificially depressed prices. The paper price is their weapon, but it is also their weakness. They need the paper price to stay low to avoid margin calls. But every time they smash the paper price, they make physical silver cheaper for the accumulators who are draining the vaults. They are fighting a battle they cannot win. Second, expect the physical market to decouple from the paper market. We are already seeing this in the premium structure, but it will become more extreme. There will come a day, probably sooner than most expect, when the COMEX price is completely irrelevant. Dealers will stop quoting based on spot plus premium. They will quote a single price based on what the metal actually costs to acquire. When that happens, the paper price could be $80 while the physical price is $150. Do not be fooled by the screen price. The screen price is a derivative. The physical price is reality. If you own paper silver through ETFs, futures, or unallocated accounts, you own a claim. If you own physical silver in your possession or in allocated storage, you own the metal. When the music stops, only the people holding real chairs will have seats. Everyone else will be standing in line at a bankruptcy court wondering what happened to their claims. Third, expect the banking crisis to spread beyond silver. Silver is the canary in the coal mine, but the mine is full of gas. The same leverage, the same derivatives complexity, the same counterparty risk that is blowing up in the silver market exists across every asset class. Interest rate swaps worth $500 trillion are ticking time bombs waiting for volatility. Currency derivatives worth $100 trillion are vulnerable to central bank policy divergence. Credit default swaps worth $10 trillion are pricing in zero risk even as corporate debt reaches record levels. Silver is the match. The financial system is the powder keg. When the silver short squeeze forces the first major bank to fail or be rescued, confidence in the entire system will crack. We could see a cascade of bank runs, not physical lines at the ATM, but digital transfers as sophisticated depositors move their funds to safer jurisdictions. This is why owning physical silver is not just about price appreciation. It is about owning an asset that exists outside the banking system, that cannot be frozen by a government decree, that cannot be bailed in to rescue a failing institution. Physical silver is financial insurance against a system that is visibly breaking. Fourth, expect the monetary system to change. The current dollar-based order is not sustainable. The U.S. government is running $2 trillion annual deficits with no plan to balance the budget. The Federal Reserve is trapped between fighting inflation and preventing banking collapses. The BRICS nations are actively building alternative payment systems to circumvent dollar hegemony. The weaponization of the SWIFT system against Russia demonstrated that dollar reserves are not safe for any nation that might displease Washington. The world is de-dollarizing slowly but steadily. And when the reserve currency changes, the transition is never orderly. It involves a repricing of all real assets against the declining currency. Those who hold paper claims will find their wealth evaporating. Those who hold real assets, land, commodities, precious metals, will find their purchasing power preserved or enhanced. Silver at $100 is not the end of the story. It is the beginning of the repricing. Silver at $100 in today's dollars might be silver at $300 in tomorrow's devalued dollars. The nominal number matters less than the relative purchasing power. What matters is owning the metal before the repricing happens. Let me tell you what this means for you personally. The $390 billion loss that the banks face is going to be paid by someone. If you are sitting in cash, in money market funds, in bank deposits, you are going to pay through the inflation that results from the bailout. If you are sitting in equities of financial institutions, you are going to pay through the dividend cuts, share dilution, and potential failures that result from the losses. If you are sitting in bonds, you are going to pay through the interest rate volatility and credit downgrades that result from the systemic stress. The only way to avoid paying for the bank's mistakes is to position yourself on the other side of the trade. Own what they owe. Own the physical silver that they have sold and cannot deliver. Own the asset that they must buy at any price to settle their obligations. This is not about getting rich. This is about not getting poor. This is about protecting your family, your savings, and your future from a financial system that has been rigged against you for decades and is now visibly failing. The banks face a $390 billion loss if silver hits $100. They are panicking because they know the loss is coming and they have no way to escape. The vaults are empty, the shorts are trapped, the margin calls are mounting, the Fed is printing, and the price is rising. This is the moment that silver investors have waited for through years of manipulation, years of paper smashes, years of ridicule from mainstream analysts who called them crazy. You are not crazy. You were early. And early is not the same as wrong. The math is finally catching up. The leverage is finally unwinding. The truth is finally being revealed. And those who positioned themselves correctly are about to witness the greatest wealth transfer in modern financial history. The transfer is happening right now. The only question is whether you are positioned to receive or to give. Choose wisely. Stack strategically. And remember that the number on the screen is not the price of silver. The price of silver is what it costs to put an ounce in your hand. And that price is rising every day as the banks scramble to find metal that does not exist to cover promises they never should have made. I am Vault Zero. This is the breakdown. The $390 billion bomb is ticking, and when it explodes, you will either be holding the metal or holding the bag. Like and subscribe if you want to keep seeing the truth that the mainstream media refuses to report. Share this video with someone who still trusts the banks, and I will see you in the next report, where we will dig even deeper into the mechanics of the collapse and how to protect yourself from what is coming. The silver squeeze is not a meme. It is not a movement, it is mathematics. And mathematics always wins. See you in the vault.